All right, hey broker family, thank you for joining us on this Facebook Live. We have none other than the infamous Kevin Peranio, KP. What's up, KP? Thanks for joining us, man. How are you?
Thank you, brother. Thank you, Brennan. You're doing a great job, man. I love seeing you on stage at Fuse, and you guys got such a strong leadership team, man. Thanks for helping shepherd the flock.
I appreciate you saying that, man. We love what we do, and we love the broker community. But before we get into the boring stuff, what's going on with you, man? You have any fun New Year's plans, or what's the latest and greatest?
Well, I'm sure some of you know that I've got 4 children, and they're 2, 4, 6, and 8, and they appreciate mama because I'm always on the road. But yeah, we're just hunkering down for the holidays, trying to get ready for 22, finish 21 on the run, and start with a new you in 22. That's my little saying I've been coining, and it's borderline cheesy dad joke. So
I mean, it resonates with a lot. I like it, man. I like it. So along those lines, we're definitely going to be talking a lot about looking forward to next year. Let's look back quickly. Looking back at the last year, what are some of the things that have happened in our industry, some of the events that you think have been most impactful and are going to things that happened last year that are going to change our industry forever going forward? And it's pretty open-ended, but tell me what you think of when you hear that question.
Well, it's interesting. I think, and I don't want to say this I'm not trying to offend realtors, but 10 years ago, realtors were the gatekeeper, right? When it came to purchase business, right? So we're all talking about purchase business and purchase money activity. And, I think realtors and originators are challenged with the same thing right now. And that is, how to find borrowers that are looking to purchase. And, it's not a knock on the profession of realty, but borrowers are online. Borrowers are out there. They're searching online. They're looking for information. They're also getting younger. They're skewing younger. They're millennials. They make up the largest first-time homebuyer demographic. So I think next year you're going to see, a lot of those people that have been setting up systems to do a little bit more consumer direct activity. I'm not saying start a call center tomorrow,
Sure.
But I'm saying find your borrowers where they're at. And, they're skewing younger and they're in different places than they were before. Obviously the realtor relationships are still gold. I mean, the strength in numbers approach that an originator and realtor can combine together and create is going to be very, very important. And both of them have to go find the borrowers. Borrowers are in different places now. Some are very scattered, some are concentrated. But I think the real trend here and the really way to win is win local with a mix of finding borrowers where they're at in a little bit more modern way. And so we've been calling it our path to pivot this year. 2 years ago, we were talking about speed to lead. And our plan for next year, we're trying to ditch the word pivot. We think it's totally overused. We think people have already pivoted. Since May, purchase money has been growing, May of this year. So we are going to now say, all right, all this stuff you've been doing, all these systems you've been working on, all these new action items you've been kind of looking around. Now it's time to take action. Now it's time to go. Now it's time to launch. Now it's time to actually enact these plans, but win locally. Remember, you have knowledge inside your head that people just don't have. What's a good school? What's a good neighborhood? What's a good this? What's a good that? That together combined with being a little bit more modern in our approach to finding borrowers, we think that's a winning combination. And it's not too late to start. If you've been spearing refi loans out of the sky because it's easy, it's not too late to start, pivoting towards more purchase money and consumer-facing activities. But you've got to do it. You've got to do it. All the projections for next year is, less volume. That doesn't mean you can't double your volume next year. There's going to be less volume, but I think a lot of these refi shops are going to really hurt. And those of us that are rooted in our communities, deeply rooted in our communities, are going to win on the purchase front.
I couldn't agree with you more on many, many fronts. And speaking personally, on my personal production, in 2020, we were 82% refinances. And in 2021, we're going to finish year over 50% without a volume decrease at all. We were 82% refinances to over 50% purchases without a volume decrease at all. And it was a big, big focus of ours. Mm-hmm. And I'm not doing realtor marketing or anything like that. And I have found more and more that consumers are very open to speaking to a loan officer before speaking to a realtor. It's just the realtors are the ones that have been marketing them for all this time, right? The realtors have been the ones doing the consumer direct marketing, and then we market to the realtors. But you can flip the script, and the benefit on top of all that I found is now I'm in a position where I'm referring out business to my realtor partners and the ones that I do work with, and those relationships are even deeper. Are you seeing like is there a shift in consumer mentality to talking finances before talking with the realtor, or has it always been that way and people haven't been put in front of them? Or what are your kind of thoughts on that?
I do think that it's you're talking about financial literacy. Originators have done such a good job of positioning themselves as an advisor more than just mortgage. It's about someone's financial well-being, and so I would say that's why you're seeing consumers kind of feed off that trend. Plus, all the advertising you see out there from the consumer direct lenders, it's mostly mortgage rather than realtor. So you see commercials when you're watching sports and you're constantly thinking about your mortgage, your mortgage, your mortgage. Doesn't mean you call one of them, but they're helping us all be at top of mind as an originator on the mortgage side. But then once they get you on the phone, like you're right there in the community. You're not, some little, guy on a headset in Detroit. You're actually in the community and really knowledgeable, and you're able to, help them.
I know that neighborhood, or that kind of thing. Yeah, for sure.
That's very impressive that you were able to make that switch and keep your volume. I would ask you, and this is something, as we're goal setting for 22, and it's interesting, you said volume. Now, I'm assuming you said that, and maybe your units have come down a little bit, but because loan amount sizes are larger, because there's units and there's volume. So maybe tell me what you're seeing, and I'll tell you what I'm seeing on
overall production. Both have been the same. And if I'm being completely transparent about it, so the first couple months of the year was still more heavy refinance. And as we're sitting here right now, I'm at about 75-80% purchase.
Nice.
My units are down. I was doing about 50-60 units a month on average last year. And now I'm at about anywhere from 30 to 40 type of thing. But it's all purchase business. And if you want to talk about overall profit at the end of the day, that has actually gone up despite our units going down, because I'm no longer competing on these purchase deals with online lenders, right? With the better.coms of the world and their ultra thin margins. I'm competing by and large with local retail shops and their big fat margins. So I'm not having to get skinny on any deals to win them. I can do lender paid comp and crush every single deal. We actually got rid of we used to have a cap on our broker compensation. We got rid of it and saw zero pushback whatsoever. So
wow, that's impressive.
Just adapting to the market, right? I'm in the DC metro market and everyone's refinanced. You give the people around here a year and a half of rock bottom interest rates, they're going to refinance. They're fiscally aware. So it's just a purchase market now.
Do you call it the DMV? DC, Maryland, Virginia?
Yeah, baby. Go to dmvhomemortgages.com, baby. It'll take you right to McKay Mortgage, my man.
I love it. I mean, how about that? Hey guys, go create a landing page, right? Go, steer that traffic to you. It's very interesting because, regardless of what party is in office, DMV, DC area is always growing, right? So there's, the government gets bigger, we're spending more money. There's a lot more, there's a lot more work out there, right? So your loan amounts are enormous. The conforming loan amount, the VA, FHA county loan limits, I mean, everything's been raised. Yep. So, I think where unit count may be down on rate and term refi, purchase will for sure be up if you've got systems. I think cash out's going to surprise really big to the upside. I think even as much as 25% increase of your cash out volume next year. But then all of whatever decreases from a unit count from rate and term refi will be offset by larger loan amounts just generally everywhere.
Yeah, and especially in markets where they don't have a high balance like my market does, and they're stuck at that 548 cap, and now all of a sudden it went up $100,000, right? $100,000 freaking dollars, and all those borrowers out there that are in jumbo rates that are terrible, they're easy pickings, man.
It's unbelievable. I mean, $100,000. I was floored when I saw it. We were the second lender in America to go live with the new. We went up to 625, which is kind of where everyone was like, all right, we're not willing to truly go up to 650 in case they don't do it. But we were ones that really put it out there like right away on that Thursday of that same week. And yeah, we've been seeing much larger loan amounts in our locks, and that's obviously a tailwind for everybody, no matter where you live.
No doubt, no doubt. And like, there's probably a little bit of lull right now. People during the holidays and stuff are not really looking to start the process. At least that's been my experience historically.
Totally.
And then they make their number one, probably next to weight loss, number 2 New Year's resolution is get my finances in order. And looking into refinances is definitely part of it. You mentioned cash outs going up. Why is that, or why do you think that's going to happen? I'm curious about that.
Well, let me take my jacket off. It's a little hot. I'm doing my best Eddie Perez impersonation here. I don't have guns like that guy. That guy's Jack. He's my boy.
Well, make it your New Year's resolution. Maybe you will.
Yeah. Well, you made me think of it. So look, there's I think the number is $11 trillion in tappable equity. Is the number? Has never been this much tappable equity. And so tap that. Tap that equity. To steal a line from Curb Your Enthusiasm. Tap into it. And I mean, look, people. I read an article just this morning. In full disclosure, I subscribe to like so many different services. I'm a huge fan of Stansberry Research, Louis Navellier, Platinum Growth Club. They talk about stocks and investing, but they also talk a lot about macro stuff. The savings rate and the amount of liabilities at household balance sheets is like almost zero. It hasn't been that way in decades. It used to be like decades ago. It was like you only spend money on something if you have the money to spend it. We're almost back to that zero inflection point. So there's a lot less debt, right? Which isn't necessarily the best thing for tapping into equity because people don't need it. But when you see an economy reopen, people then start to reverse that trend and they start to use their credit cards. It's hard to get a new car right now, right? People are kind of like, okay, when is gas prices going to come down? Am I going to get an electric vehicle? Am I going to get a new car? And they want a new car, but they're so expensive right now because, we're in the middle of this supply chain shortage. We don't have semiconductor chips, which make it hard for there's tens of thousands of cars sitting in factories for all the major auto, dealers and manufacturers. They can't get them off the lot, right? So it's a supply and demand, just like it is in housing. So I think people will start to spend. They'll start to buy the cars. They'll start to buy more stuff, and they'll raise that debt. And they'll be sitting there looking at, okay, what's a cheap way to get out of this? I think HECM mortgage is another way to get to it. Go through your list of everyone 62 years and older, and just go give them a HECM loan. They'll talk to them. Drip that in the back of their mind. People don't know about the HECM purchase. We're working on a HECM product. We'd like to roll it out for TPO. We're kind of refining it in-house. We'd love to do that. It's not there yet. We did just roll out non-QM in-house.
Awesome.
So I'm not trying to make this a PRMG commercial, but we're trying to give more products for all of our originators out there, including an in-house second lien. But we think that being able to tap into equity, being able to consolidate someone's debt, whether using the MBS Highway tools, the debt consolidation tool, helping people tap into that and reduce their load. I mean, we think that's a huge, huge surprise to the upside. And you can do it and probably get away with a cash out and still be under 80% LTV because there's so much equity out there.
So much equity.
Have that little MI payment. So we're really bullish on purchase. We're really bullish on cash out. And we think the loan amount sizes are an extra little boost as well.
I agree. And you mentioned non-QM. You're looking at a broker who closed his first non-QM loan today. I'm very proud of myself.
Hey, congratulations, man.
Thank you.
Good for
I was
you.
so scared for so long, and I that greed got me, frankly. I mean, helping more consumers, of course, but I had referred out a couple multi-million-dollar non-QM loans, and I'm like, I gotta stop doing this.
I want to tell you something. So the loan amount size on non-QM is enormous. They're enormous, and they're not as hard to do as a jumbo loan, right?
Way easier. I can tell you, it was so much easier than I thought it would be. Yeah.
Well, obviously we're able to help you out as well. So
yeah, man. When do you guys think you're going to roll them out?
It's out. It's live. It's done. It's on our rate sheet.
All right. Love it.
Yeah, guidelines are out. Rolled out last week. We're live. We've been taking in locks. Let's lock and load. So
and I do think non-QM is going to be a big growth area for brokers for a lot of reasons. One, the products are just getting more and more refined and streamlined, but I think you're going to see a lot of self-employed borrowers that frankly had a rough time during the pandemic and during shutdowns, and their 2020 tax returns are going to look awful, or their 2019 tax returns are going to look awful, and they have 1 year bounce back, but they don't have the 2 years that they're going to need on Fannie and Freddie or traditional jumbo guidelines. And non-QM can serve those borrowers, whether they're only needing 1 year of tax returns or whether they're doing bank statement loans or whatever it is. I think there's going to be a massive swath of disenfranchised borrowers, frankly, that just the traditional market is not going to be able to serve, even more so than normal.
Yeah,
so I definitely think there's a lot.
100% agree. I would say when you run DULP, you know, if you've got someone who's had their business for 5 years or more, you might get the 1 year self-employed tax returns, which obviously is huge. Everyone's filing. Like, now's the time when you're coaching self-employed borrowers. Like, okay, I know you're trying not to pay taxes, but if you want to buy this house, let me help you with your tax return, and let me help you. Yeah, you're paying more taxes, but then you get to report more income. Therefore, you can actually afford the house that you want to buy. Yep. So you get a chance to like reach out and touch all your self-employed borrowers. Hopefully you have a database. You just sort by self-employed and then just call them one by one and say, hey, if you're looking to do a refi or a cash out, I want to make sure that I help you with your tax returns so you can qualify for this. Now, of course, non-QM is there. And by the way, like, we're overwhelmingly an A-paper lender. I mean, we do a tremendous amount of A-paper. We also do government. We do some, manual underwrites, and of course, non-QM. I know that like a lot of people got, some lenders, some of our competitors, they got afraid of like some of the giant lenders that were, really putting out good systems and really taking care of A-paper loans in like an assembly line fashion. And so then they got away from A-paper and they started becoming known as a non-QM lender. We don't want to be known as a non-QM lender. We don't want to be known as your garbage, tough borrower lender. We do all of it. We want to be known as your one-stop shop lender with an underwriter that underwrites the whole file that you can get on the phone and talk to, or an account executive that actually lives in your area that you could talk to. That's us. We're a service model, and that's our deal. So, if you want to know who we are, but on the non-QM front, let's talk about non-QM. I mean, Dodd-Frank worked. Like, as much as we all hate regulation, we hate it. I hate the LO comp part of it. But Dodd-Frank worked. They carved out non-QM, and when the crash happened from the pandemic, Fannie and Freddie were protected. Fannie, Freddie, and Ginnie were good. All you non-QM lenders, you had to stop, you had to pause, you had to get ready and let the secondary market decide when it had the appetite to buy those again. And now they're all back out. We were doing non-QM in-house before that for all three channels, and now we're back to doing it again for all three channels. So it's interesting to see how Dodd-Frank and that regulation worked. It protected the Fannie Freddie portfolio and book.
And the free market did the rest. Yeah, absolutely. And I love that you guys are back doing it and other lenders are back doing it, because like, I already have a relationship with you guys. I already have a relationship with these other lenders. And like, especially if I'm dipping my toe into waters that are new for me, like I gotta have somebody I know, that has my back and like is gonna help me, because it's not that hard, but it is a little bit of a different language, and you gotta take your time with it and stuff. So I love it, man.
Here's another thing, and I appreciate you saying that, because all the AIME lender partners are absolutely phenomenal. I mean, I know all the executives are really, really good people. And what I would say is one thing that I would say that's different and unique about us is we're really into decentralized fulfillment. And it's interesting. I see some Facebook chatter sometimes, and like someone will say like I really hate PRMG because my AE doesn't call me back. Right? We have like 80 AEs covering 80 different areas and markets and groups. We also have multiple fulfillment centers. We're decentralized, right? So if you sent like your down payment assistance loan and it's the first one you've ever done in your career, and it's really hard for you and your team to process, and it's really hard for us because it's a hard loan inherently, and that's the only thing you ever sent to us, and you send it to our one center that's over here, doesn't mean that all of PRMG sucks. Do you know what I'm saying? So we actually have a fulfillment team and sales team in Northern California run by Michelle Lilly with a bunch of fantastic team NorCal. They also do the Pacific Northwest with a bunch of fantastic account executives. Then we have a team down here out of our Corona office, Alex Del Haro, and he's got a couple sales managers and a bunch of account executives down there. And they also do wholesale. Then the rest of the United States, Herb Lewis is one of our divisional VPs, a gentleman who I respect so highly, a mentor of mine for many, many years. He is our divisional VP, and he's got 4 regional managers. So we just opened 3 new centers.
Oh yeah.
Okay. 3. Wait, now they were already there, but we promoted sales managers up to regional managers. So we have a long running one, Joe Spangenberg, who's in Arizona, and he's out of Phoenix. He works the Southwest. We got Corey Prozaki, who's running the South East. And then we got Ryan Goldsmith, who's up north of Philly, and he's working the Northeast and Mid-Atlantic. And then we got Mike Miller, who's a regional manager over the Mountain region and the Midwest. So we are tripling down on our decentralized model. We're not cutting staff. We're not consolidating into one big mega center. Like, we are spreading out and being local, because that's how you win. You don't just win being local as an originator or a realtor. You win also with local fulfillment and local account executives. That's our model. That's who we are. So just want to get the word out there for those that are listening.
I love it, man. And that leads into like the last question. It's like, what does PRMGs have in store for 2022? Like, I love to hear it, like coming off, you know, record years and all this stuff. Like, you guys are putting it right back into the business, it sounds like. Is that fair to say?
Yeah, 100%. You know, we have this thing where, you know, our CEO and founder, there's two founders. There's Paul Rozo, our CEO, and then Robert Holiday. And I've been with this company a little over 11 years. I've been a partner at this company almost 6 now. So I moved from Fort Lauderdale to Southern California almost 6 years ago now. And then Gary Malice, he's our chief strategy officer and capital markets officer. Absolute brilliant genius, great guy. And so, you know, the 4 of us, it's privately owned. So you're like, we're ready for next year.
Oh yeah.
You know, we don't answer to any hedge funds or equity firms or REITs or a bank or, you know, the public markets. And again, I don't want to paint all companies that are public the same, because you have to actually look at how much of the company is public. You know, like I'll give an example. So like, you know, Matt Ishby at EWM, it's only 9% or 7% public.
Yeah.
He's still very much in control. So he tapped the public markets to get more cash to have and fund a better business. So like when people say like, oh, this company's public, it doesn't mean that they cater to the whims of the a-holes on Wall Street who hate our industry, by the way. So you know, not all things that are public are the same, but we're completely private, right? So we have our own cash, we have our own money, we feel good about where we're at. We're investing in our pricing, we're investing in our people, but our customer, okay, is the originator and the account executive. It's not the borrower, it's not the builder, it's not the realtor, it's not the Yelp review. It's our originators. We are built by originators for originators. We are here to serve originators and our account executives. If we make our account executives happy, of course the brokers will be happy.
Yep.
Of course, you know, they'll be happy because our AE, they know what's going on. So we're investing in our account executives. We're giving them more tools in Salesforce so they can get more information about the accounts, be more organized with their thoughts, building more stuff out for them so they have more time to answer your questions. We have more concierge service for our brokers. We're beefing up our staff internally. We're rolling out automated disclosures. I mean, we're already doing it right now. I know, it's so cool.
Hell yeah, man. That's awesome.
Oh, it's going to be huge. So we're already doing it right now with conforming with a test group of brokers. We're waiting for like a couple more business rules to come from ICE technology to make sure FHA is there. But we're like super close on fully automated disclosures. We've got Uber style appraisal ordering. We use software through Regora. So we've got a bunch of stuff. We're trying to invest in the channel, and you know, we don't grow without TPO. It's plain and simple.
Love it. I love it. I love it, man. Thanks for joining us. KP, everybody, we love you. Don't love the helmet in the background, but we love you. We appreciate your support. And Merry Christmas. Happy holidays. Cheers, man.
Hey, cheers, everybody. Happy holidays. Thank you.